When you have the allowance, you would only typically use it when you're adding things to the allowance, yes. So we are recording now, and I passed everybody out the handout number 11 for chapter 9, and it's got 4 practice questions on there, and these are just examples of concept questions that you guys might have on the test. You're supposed to have read chapter 9 by now, so these are just some practice questions for you to see how well you remembered them. I'll give you guys like 2 minutes just to look them over and guess your answer, and then I'll go over the answers. These are not a quiz or anything like that. You're not turning them in. It's just for you to see how well you're absorbing the material. Okay, so let's take a walk through these. Which of the following is not a major characteristic of a plant asset? So plant assets, we'll talk about the characteristics of them, but one of it is that it's not acquired for resale. Things that are acquired for resale are either going to be an investment or inventory. And so that would not be included in plant assets. Fences and parking lots are reported on the balance sheet as land improvements. When boot is involved in an exchange having commercial substance, and you're like, what's boot, right? It's not an actual boot. It's not a cowboy boot, right? Boot is when they have cash involved in the transaction, and so somebody's getting cash as a result. And so gains and losses are recognized in their entirety. And then the last one, in which of the following situations would a cost incurred after an asset's acquisition be capitalized? So we'll talk about this. These are some improvements, and the improvements have to either extend the life, produce better quality, or produce more quantity. And so in this case, the useful asset of the life would be increased. I know you guys love it when I start with a big blank page because I make you take notes, and I apologize. It's a lot of writing for this first part, but hopefully it'll help you understand about property, plant, and equipment. So property, plant, and equipment possess characteristics that distinguish them from other assets and so one, they're acquired for use in operations. They're long-term in nature and usually depreciated. And they possess physical substance. So we'll learn in the next chapter about intangible assets, which are more like legal agreements, which is part of your long-term assets. But these are the physical things. These are equipment, property, and plant. And they usually have an associated depreciation account, which would be called accumulated depreciation. And so we use historical cost to report property, plant, and equipment. By the way, you can just abbreviate it as PPE. So in the book, expenses that do not have long-term assets associated with them are expensed. Long-term assets are categorized as property, plant, and equipment, PP&E, or investment if planning to sell. Or land. Some examples of what to capitalize for specific types of assets. And there are additional examples in your book, and I'll kind of give you a general guide to go by towards the end here. But just talking about the ones that you'll get most often, keep in mind for land, also note, land is not depreciated. So it's just left on the books at its historical cost unless there's an impairment. All right, so land would include the purchase price, closing costs, and fees. And these would be like including attorney's fees. Preparing the land for use. Assumptions of any mortgages, fees, or encumbrances. And those would be like liens from the city or other claimants against that land. And any land improvements that have an indefinite life. Okay, so let's talk about equipment. What are some examples? So this would also be the purchase price. Delivery costs. Assembly and installation costs. Preparation of the facility. And testing, training. Get ready for use. I'll give you a minute. Don't worry, I'm not starting this one right away. Let you catch up. So for the building, this can include costs to build or to purchase. Building permits. Or fees from the government. Engineering and architecture. You can also have construction interest on loans for construction. and insurance costs during construction. So after you get done with the building, in general, what is capitalized is the purchase price, freight and shipping costs to get ready for use that are normal, and any abnormal costs are expense. So if you make a mistake, if there's some damage on it that needs repairs, those get expensed. Those are not part of the purchase price. Long-term assets should be checked periodically for impairment, which is a loss in the ability to produce future income. And written down, it's a loss impairment. If the impairment and written down if the impairment causes the fair value to decrease below the book value. And then remember, leases are also covered in this chapter. A lease is an agreement to use an asset for a certain period of time. Once you get done writing that in, we'll jump to example 1 and I'll go over it. Okay, it looks like pretty much everybody's there. So Previn Brothers Incorporated purchased land at a price of $27,000. So we know we include the $27,000 in the cost, plus the closing costs. Plus it says an old building was removed, and that's to get the land ready for use. So we include that. And so our cost would be $38,600. Okay, now we're going to go to example 2, and I'd like you just to take about 5 minutes with this question and kind of figure out where you think it is. Put a little L if it's L for land, B if it's for building, and N if it's for neither along here, just to kind of get you practicing and thinking about this. And then what I'll do is we'll go over it and we'll put the answers in the grid that's below. Might be on the next page for you. Oh, it's all on the same page. Good. And again, this is not a quiz. It's nothing that I'm recording. This is just for you to see where you're at. If you have any questions as I go around, let me know. I'm looking for little L's and little B's and little N's. Make sure you're trying. Most of the people are about halfway through, so another minute. We'll go over these. All right. So always make sure to read the instructions, because it says assume the land survey was for the building. So as we're going through that, we're going to have to make sure that we appropriately classify that. So the first one we have says purchase land as a factory site. So we have 400,000 for land. Payment to raise old buildings. So again, we said that goes into the cost of the land, get it ready for use. Sale of salvage lumber and brick from raising. So they were able to recycle some of those materials. So here, this reduces our cost of the land by $6,300. Payment to an engineering, Did I get this right? Legal fees, sorry, paid for title investigation and drawing the purchase contract. And so legal fees here for the land, $1,850. Now it says assume the land survey was for the building, so this is going to go to the building for $2,200. Now it says here survey had to be made before definitive plans could be drawn. Sure, it would only be expensed if the building didn't go through, right? Otherwise, we're capitalizing as part of the building. Payment for drawing the factory plans. So now we're moving over towards the factory. We're building 68,000. Title insurance on the property. So this is property. It doesn't specifically say building, so 1,500 on land. Liability insurance premium, this is during construction, so that's 900. Payment to the contractor, first installment at the end of 3 months, or no, contractor's charge for construction, sorry, 2,740,000. So that goes in there. The payments are already accounted for in the 2,740,000, so we don't worry about those. And then interest costs incurred to finance the construction, and that goes into the building as well. Sorry, it looks like it kind of pushed the total column over to the next page. But you have totals. 439,050, and you're building 2,981,000. 2,981,100. Any questions there? So when you looked at your books, you'd have land on your books and building, and this is what you would see. Okay, so when we talk about what we're capitalizing versus what we're expensing, what is the cost of it? This would be the historical cost and the basis for what we're going to put both of these assets on the books. Now, for the most part, they will stay on the books until they are sold at that value, or unless there are significant improvements on them. You know, if you were to take the building and remodel it in 20 years and extend the useful life or extend the quality of it, then you would add to that or probably change your depreciation schedule. It depends. All right, let's take a look at example 3. Example 3, ARO, that abbreviation that they use there is asset retirement obligation. So we are being a little more strict now, and I say that because we haven't been for a long time, and we still have issues with businesses going out of business, but you guys are probably familiar with the Texas well issue, right? There are a number of wells that were not properly blocked up after they were being used in the state of Texas. There's thousands of them and they leak. So this asset retirement obligation is basically something that the company should take into consideration when they're doing things like wells or putting oil tanks in the ground, anywhere where they have to return the ground or land back to a state that it was before they got there. And so they have to think about, okay, how much do I need to do to account for that? And what they do is they put it on their books at the present value. So if they know it's going to cost them $5 million in the future, they take their discount rate and calculate the present value back to today's value of it. So something that's $55,000 now in 10 years could be the $100,000. So that's what we see, the present value here of that asset retirement obligation. So When we have an obligation like this, it goes into the cost of the building. And the amount 55,839 is our present value of it. And then we have a liability, which is called asset retirement obligation. And that credit is for 55,839. And so now they're saying, okay, what do we have to make for the entries for 2025? So at the end of the year, we have to record depreciation expense, and it's depreciation expense on the asset retirement obligation. So depreciation expense. And this is the 55,839 divided by 10 years useful life. And we get 5,584. And that's accumulated depreciation for the building. 5,584. And then we have what's called an accretion expense. And that is basically the asset price or value, the book value of it, and we multiply it by 6% because we want to increase that asset for 10 years until we get to the 100,000. And so our liability for asset retirement obligation increases. In this case, is 3,350. Any questions? Okay, let's take a look at example number 4. And so this one's pretty straightforward. We have land improvements. And it says the fair value of the obligation is 84,000. And so we have an asset retirement obligation of 84,000. Okay. Number 5, Caliph Drillers erects, and places into service an offshore oil platform on January 1, 2025 at a cost of $10 million. It estimates $1 million cost to dismantle and remove the platform at the end of its useful life, which the company is legally required to do. The fair value at January 1, 2025 to dismantle and remove is $450,000. So here again, we're going to debit oil rig. That's the asset for $450,000. And then we're going to credit asset retirement obligation for $450,000. Okay, so now we're talking about costs related to property, plant, and equipment after acquisition. So it costs quite a bit to maintain equipment, maintain buildings, and so we have to figure out what's going to be capitalized versus what's just an ordinary expense and going to be just expense. So costs that are simply maintain the level of service, ordinary repairs and expenses, those just get expense. So janitorial costs, costs cleaning, basic small repairs and maintenance, those don't change anything. The only time we capitalize costs is if one of these three options are met. And one, does it increase the useful life? Does it increase production quantity? And if it increases production quality? And so what are some of those additions? You kind of create a new asset, improvements and replacements, rearrangements and installation, or major repairs, not anything small. So like a new roof would be something that would generally be considered a major repair and extend the useful life. Okay. Any questions there? So we have improvements and replacements and substitutions. The question is, how do we accomplish these capitalizations? So it's not always easy to figure out what we should do. And so there's three kinds of ways that they do it. One is they substitute the new cost. I'm sorry, the cost of the new asset for the old asset replaced. One, they can also capitalize the new cost without replacing the old asset. And the last one could be they could debit the related accumulated depreciation. Rearrangement and installation costs are carried forward as a separate asset. And amortized over the future life. Okay, so let's take a look at example 6 and indicate which one of the following costs should be expensed when incurred. I give you like a minute to kind of decide on your own, and then I'll walk through them with you. Okay, so it says indicate which of the following costs should be expensed when incurred. So 13,000 paid to rearrange and reinstall machinery. Now, it doesn't specifically say that it does any one of the three, but you would capitalize this. Number two, 200,000 paid for an addition to the building, you would capitalize. $200 paid for a tune-up and oil change on a delivery truck. That would be expensed. $7,000 to replace a wooden floor with a concrete floor. So this one's a pretty low amount, probably be expensed. And $2,000 paid for a major overhaul on a truck, which extends its useful life. And this one's, again, it's kind of low, but you would capitalize it. Now, again, these are relatively small amounts. So if you go into a place and they're like, listen, man, we expense anything under $10,000, then you could actually do that, right? We see these as kind of big numbers related to us, but for a company, this stuff is small stuff. Now, most of the time you'd be talking about this is if they were in the hundreds of thousands of dollars, but usually all this stuff would be expensed except for the building in the real world. But book definitions specifically capitalize, expense, and capitalize. Any questions? Okay. So now we're talking about depreciating assets. And we've talked about this before. The concept should not be new. When we buy a long-lived asset, we have to figure out how to expense it. And accounting is all about matching expenses with the period that they earn revenues. So buildings, usually it's like 40 years. A car is like 5 to 7 years, truck, something like that. Any type of computer equipment is much shorter lived. And so what you're doing is you're putting that asset on your books at the cost. So we did that with the land and we did that with the building, right? And then we're saying, how long is the useful life? And based on that, we are going to expense a portion of that useful life each year until that machine is no longer being used by the company, until that building is no longer being used. And so we have a couple different methods that they cover. These are by no means all the methods. They're the most commonly used methods. So straight line is probably the easiest of it. The formula equals the historical cost less the salvage value divided by the useful life. And that gives you the annual depreciation. To apply depreciation, multiply by the number of months in service in that year divided by 12. So if it's in service for the whole year, it's 12 divided by 12, and so you don't worry about it. But if it's in service for only a partial year, you would take, let's say, if it's half year, 6 months divided by 12, and multiply that by the depreciation amount. Okay, the activity method formula equals historical cost minus salvage value divided by the estimated units of production. And to apply it, you multiply the rate above times the actual units of production. I know I didn't give you much space there, I apologize. Double declining balance method. So for this one, you calculate the straight line percentage of depreciation by year. No, not by year. Yeah, it is per year. Divided by and so how you do that is you divide 1 by the useful life. So for example, if the useful life is 5 years, then 1 divided by 5 equals 0.2 or 20%. So we would multiply 20% by 2 equals 40% per year. And to apply it, you multiply the percentage times the book value. And a little note at the bottom, do not depreciate below the salvage value. It's pretty hard to do unless you make a mistake with the straight line method. But with B and C, it's fairly easy to do. So you want to make sure that you do not depreciate below the salvage value. Okay, and we'll start here next class. If for some reason you are voting and it causes you to run late on Tuesday, don't worry about it. Just come because it is voting day and obviously that takes priority. You'll still have to be responsible for the class, but you know, if you miss it, it's not a big deal. You'll find the video online. Also, the exam, the second exam is not going to be this weekend. It'll be next weekend once we finish chapter 9. Okay? Thank you. Have a great weekend. Do take the time to vote, please, if you are registered. Have a good weekend, Giovante.